Good morning and welcome back to Almus Market Mornings. Wall Street finally took a breather with the US Treasuries rebounding after last week's sharp sell off, but uncertainty remains as the Trump administration's shifting tariff stance keeps markets on edge. Japanese stocks led gains in Asia today, while US futures dipped slightly. The euro is rallying strongly, some even calling it safe haven, though that view is still debated. JK, with the dollar under pressure and tariff messaging still unclear, how do you see this playing out for the rupee?
Good morning, Swaraj. I think rupee is, I would put the rupee as in a very stable place right now. It's still absorbing all the global news and even the deep risk of sentiment in the global markets did not see the rupee even cross 87. Um, and that's normally what is seen in times of crisis, but that does not happen, at least so far. And it has been now settled into a very stable range between 8580 and 8650. And I think the way news is evolving and the baby steps that the US government and policymakers are taking towards stabilizing the markets, which had gone into a kind of crisis mode, is encouraging for more stability for the currencies and particularly the rupee. And what is also heartening is that the Chinese yuan has stabilized after threatening to break out to the upside, trading as high as 7.42 and now steadily trades around 7.3032 levels. But on the global markets, yes, after the mayhem that we saw in the stock market in the first week of this month, things seem to be settling down somewhat. The U.S. government, as you know, after the first step of announcing 90-day pause on tariffs, also started, relaxing a few items for tariffs, like the software for the Apple phones, iPhones, and all, which actually is a relief for a particular sector, which means that U.S. government is actually looking to protect itself from any disruption due to these tariffs. So there will be selective moves in this regard, and there is hope that most of the countries will negotiate and get down to much lower tariffs. So that is the reason why the stock market has somewhat stabilized. We had seen the second week, the crisis spread to the bond market, and the bond market was, of course, triggered by a huge rise in the yields after the 90-day pause, and people fearing that the if the tariffs were not as high as earlier and the tax cuts were also imposed, the deficit will remain unaddressed, and the huge amount of dollar bonds that need to be rolled over by the US government will face higher interest rate, and therefore the deficit seems unsustainable. And that's the reason why the bond market sold off and the yields went up as high as 70 basis points within a week. And on the way, we saw some big hedge funds based in Japan also bail themselves out of the positions, leading to further stress. And there was also rumors about the basis trades, which the large investors involved in to take advantage of the price difference between the spot and the futures market. That also got unwound because of the huge movement in the spot prices of treasuries, all indicating some market started feeling some sort of larger crisis evolving. And the crucial levels on 30-year yield at 5% and 4.5% in the 10-year. These were very closely watched. So far, they have been held. And my view is that this market will be much more closely watched by the policymakers in the US, because it's very crucial not only for the US economy but also for the global economy and the markets to remain stable. And we do not nobody wants another 2008 type of global financial crisis. And so I think the way markets are behaving the last couple of days is giving some hope. On the inflation side, also, we had better news in PPI after the softer than expected CPI. And yesterday's inflation expectations from US consumers was definitely higher, but not as high as the Michigan survey had indicated. And in fact, the longer term inflation expectations have come off for that is for the 5 years. Although the background of why these expectations have reduced is also because people expect the unemployment to increase, and this eventually leading to lower consumption, and that is seen as a reason for the prices to come off, but I think this is something we need to wait. All said and done, the lower CPI and PPI numbers are likely to translate into a lower PCE inflation number for the Fed, and that will be encouraging sign for the policy. Although eventually what shape the tariffs will take will determine the how the Fed moves further. In the meantime, there has been some comforting statements from Fed's Valor, who generally is a bit hawkish, but this time he was saying that when the CPI data and the PPI data showed a weaker number, they estimate that the PCE number will be even close to their target of 2%, falling to 2.3%, and that is very comfortable for the Fed, and they can hold off any policy move for the time being. In any case, Powell has said that the tariff-related inflation will be transitory. Although economic news is somewhat in the background, in the face of the tariff news and other globally important policies from the US government, but these are something that can eventually keep the bond market somewhat better supported. And that's what we saw in yesterday's trading as well. And we do have, of course, more economic data in the form of retail sales today, which will be watched for how the consumers are behaving, because the tariff news has been there for quite some time, and whether they have increased their stocking up of goods. So a higher number may actually mean that they have been stocking up the goods ahead of the higher prices for the goods as well. So on the dollar, of course, we have seen some sort of stability emerge in the recent days. See, if you look at the dollar's move in the last little over 2 months, it has moved down by about 13% from 1.0150 in the euro. It has gone to 1.1475. So it is looking a bit oversold, and the recent trend has been that whenever there is a crisis type of situation in the US markets and in the global markets, dollar tends to fall, which is a departure from what we have seen historically. But as the market stabilize, I feel this is going to see some sort of a correction. While so far the low traded has been 99.02 in the dollar index. Now it is closer to 99.80, and the important level would be in the 100.50. If that is broken, we can see some more retracement towards even 102 or something for 102.50. So I think what needs to be watched is how the bond market behaves from here on, and stocks, of course, will also take cues from the big results that are set to be announced for Q1. And we have already seen good numbers coming from the major banks, and there is an expectation that some of the companies will hold back their forward guidance, or rather they will be guarded in their forward guidance in view of the policy uncertainty. But I think stability in the stock market and the bond market eventually leads to some sort of a recovery in the dollar as well. That will be a good news. And even gold, I feel, which is been moving one way, can see some sort of a consolidation of or 2 to 3% decline can be seen on profit taking once again. For the rupee, we will be having the CPI and the WPI number both coming in today. CPI is expected to stay around 3.6%, which is a good news. Food inflation, as we know, has been on the lower side in India. Of course, the tariff-related news and the US yields might keep the markets somewhat on the guarded side, but I think Indian markets have been by and large stable, including the stock market. which has not seen any a crisis type of move compared to the other markets, and the recovery has been quite quick. Although we don't see any of the markets to recover to the previous highs in a hurry. In fact, technically speaking, most of the indices are now below the 200-day moving average, and that's a very important technical point that the market watches. And unless it breaks and closes above the 200 DMA, which in my view will take some more time, the market can be in a range on the lower band. So that is what I expect even for the Indian market. Yeah, for Indian market, of course, the flows are also important. We did have a good flow of over 3 billion in the month of March, but that has been more than erased in the 10 days of April, where we have seen nearly 5 billion of outflows. So inflows from FIS will be crucial both for the stock market in India to sustain its current recovery, although DIS have a better say, but that is also important for the dollar rupee, which currently, though holding stable around 86, has not really made much gains despite of the dollar index falling below 100. So we'll watch out the flows as well as the economic news in the CPI as far as India is concerned. Thank you.
Thank you, Rick. And just quickly summarizing, after a sharp sell-off in the bond markets last week, it seems things are now stabilizing. And just for context, last week yields went up by almost 70 basis points on the long end of the curve, which is quite significant. The data to be looked out for today would be the retail sales from the US, how consumers are holding up. That might give some idea about the impact of tariffs. One important thing JK mentioned is a higher number may indicate consumers stocking up because of this tariff-related uncertainty. In India, we have the CPI and WPI that will be released today. CPI expected around 3.6%. So good in that sense because it's close to the previous print. When it comes to tariffs, there were a few here and there's. Few items were relaxed from tariffs. Electronic sector got some pause. Now there are talk about some auto sector also being the tariff over there also being paused. So that's also one more thing to look forward to. When it comes to rupee, it continues to be stable, unfazed by the risk, the risk of. It has settled into a very stable range. And one more positive is that Chinese yuan has been stabilizing, trading comfortably around 730 after threatening to break 742 earlier last week. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.